So in this video, we're going to look at formulating the perfect setup. Now, what this is going to do is bring the processes section that we used together with the tools and techniques we spoke about in the advancing your trading section to actually show you how it all comes into play together, right? All of the Fibonacci moving averages, everything like that, how it all comes into play together to actually formulate the ideal setup. So if we look at the Euro USD chart right now, we're looking at the hourly chart currently. We've got the neutral layout on. Now, the neutral layout is a nice place to start because if we start with that neutral layout, we can actually focus on the market structure without the red and green candles distracting us. Now, what's important to note on Euro USD is that we've come out of this uptrending fashion, okay? So you can see here, all the while, we've been trending up. Now, when this broke was actually at this point here. This was the true break in trend because we see here higher highs, higher lows, higher high, higher low, higher high, equal low, and then a push through, lower low, and now a lower high reacting as resistance. So since then we've come down. This tells us the market structure is pointing to the downside. We have, of course, our trend movement. We have a impulsive move, correction move, an impulsive move, correction move. Now we'd be looking for the next impulsive move. Okay. So if we focus on the structure, we know we want to point this market to the downside, but we have to find out if there is valid reason to actually sell and where it's likely that the market will reverse. So the first thing we do is plot the key levels. Okay. We want to focus on key levels first and get those on the chart. Now, if we look at this, 1.21500. So we know we look for 250s, 500s, 750s, and zeros for our key levels. Well, this is one of the 500s. Okay, so this is one of the most rounded key levels. The zeros and 500s are generally my favored key levels to work with. So we can see that this acted as support, 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 and then it's broken. Now we can expect it to act as a resistance, but only if the confirmation tells us that. Okay. So as you can see, we've come just shy of the 50 level. Now, this can actually, in many instances, work as a retest. But we do have to be wary when this happens that the market could push a little bit higher to retest the 1.21500 level before it does actually make its move down. So what I'm going to do is just focus on the near-term structure. This is a higher low. This here potentially could be a higher low. It depends on whether we are going to push up higher. If we push up higher, then this will form a new higher low. If we push down first, we may have a different level to work with. But for now, we've got the higher low there, higher low here. And as you can see, higher high, higher low, higher high, higher low. So we can continue to push up from here. If we do come and sweep out this low after potentially, a push into that key level, we can then look for shorts. But we need to find some more confluences first. We've got a downtrend, we've got a key level. Now, what we've also got, which hopefully you can see here, is a supply zone. So we know supply zones are area where institutional participants are selling orders into the market. And as we can see, we had this consolidation before a large uninterrupted movement. So that's how we identify supply zones, as we learned in the market flow section. So clear supply zone where we've got consolidation, it then breaks out into this selling fashion down into the market. Big uninterrupted movement, so we can expect when price taps into this region again, that is going to be the place where institutions want to sell. Now, we also have that key level. So the key level and supply zone pairing up is a very nice confluence to see. Now, what we're going to do, in line with what we learned in the advancing your trading section, is add our Fibonacci tool. So we connect the swing high, which is this, to the swing low, which is this level down here. Okay. And then we're left with these three Fibonacci levels, 71, 78, and 88. Now, 71 and 78 are the favored levels. Do remember, however, that some of the volatile trades can push toward the 88 before reversing. So these are the levels we're going to look at for now and see how the price of the market reacts to them. So we can also see, moving to the moving average, we're respecting it as support. If we can push through it and show a closure through the moving average, that will then give us that selling confluence as well. Kind of in the fashion where we have here, the price reacting as support, and then we have this big closure beneath, which then drives the market down. So that's what we'd be looking for, a closure under the moving average to actually trigger ourselves into a setup. So the market is making a push into the supply zone, but as you can see, we hit the key level, we hit the supply zone, and we get big rejections. Now, what does this show us? What did we learn in the candle section? This is bearish rejections, okay? This is selling pressure up in this level, which is pushing the market down. So buyers try to take the market up, but the selling pressure here is so strong that it pushes it back down again. And that is exactly what we're seeing, which obviously when we see this with our Fibonacci, key level, supply zone, and in-trend confluences is a good sight to see, but it's not time to sell yet. So one more attempt to go higher, and then we have this big bearish hourly candle, which engulfs 1, 2, 3, 4, 5, 6, 7, 8 previous hours of price action. So we know now that we've had the reaction we wanted to see. The Fibonacci has worked nicely, the supply zone has worked nicely, the key level has worked nicely, the trend fashion has worked nicely. The moving average has now been pierced by the looks of it. Let's just see how we can go and close there. But it looks like we're now actually closing through the key level. So what I'm going to do is switch it back to the normal color theme because we have the overall direction worked out. But we've got all these confluences now. This higher low has given way. The Fibonacci's have been respected. The supply zone has been respected. The key level has been respected. And we've had a 8 or 9 hour engulfing candle, which has completely wiped out all of this previous price action and rejected very, very nicely out of the 1.2500 level. So this could be a trigger for a trade. So what we could do with this trade is keep our stop towards the top of the zone over the 88 fib. So we're looking around 30 pips on the stop loss. We can look to bring this market down. We could actually look to use this high as a stop loss point. Okay, now the reason being, we've reacted exactly as expected and now formed a lower high. Okay, no, a lower low. So when we form a lower low in a trend, we know that the high point has generally been formed, and if our trade is going to remain intact, we don't want it to pass this high again. So this is going to be the high point in the trend. Now that we've seen that push down, we can see, okay, the structure has changed. We should not come back over this point again if we're going to come down, all right? So when you're using engulfing, you have to be clever with it. If you're using engulfing as an entry and you're not seeing a shift in structure with that engulfing, because not every engulfing candle is going to be this big, then make sure you keep your stops over zones. However, when we see the actual market structure shift with this engulfing candle, we can go ahead and use it as resistance. So if we look at that, we can look for target 1, level 2750 down into this zone. So I would be quite interested in actually seeing how the market reacts in and around this zone between 2750 and 2820, because we've got, of course, this little demand zone here. And then, of course, because we are in a downtrend, we can look to continue the market lower. So for target 1, we'll just look for this. For target 2, look for a little bit of an extension further. All right. So what we could do with this then is actually go and look on the higher time frames and identify new demand zones and areas of interest. So of course, as we can see here, price and balance takes us into the 1.20 key level. This could very well be the target for the swing move here on Euro USD. And now let's see how the trade works. Could win, could lose, but the confluences are all there, and that is the importance, and that's what I'm trying to push to you. When we have all the confluences in the plan, you execute the trade. Okay, if it loses, it doesn't matter because we have our risk management strategy. Now, as we can see, if this lost, but then we won one at 2.5R, we'd still be up for 1.5R or 1.5% or 3%, depending on whether you're risking 1 or 2%. So that's how trading works. We don't have to secure, we don't have to sit and panic on a move that may lose. Okay, we follow our confluences. There is no way to 100% know whether a trade is going to win, but if you follow your confluences, you can then actually execute all the trades that fit in line with your plan, but only if they do perfectly fit in line with your plan. Some will win, some will lose, and you'll come out overall with a winning percentage. So let's see how this trade plays out. We've now seen that market surpass the next low. Okay, we're seeing it push down quite a lot. Now we are in that zone of interest. So what we may actually look to do now is take off that portion of profits that we were looking for. So say I run 2% risk, and this is the strategy that I would generally recommend to you. 2% risk, we're closing out half of the trade now at 2.29%. So we've locked in more than our risk, and we can hold the other 1% for the swing target, right? So 2.29% has been locked in. We have 2.29% running. If the market continues lower, happy days. If the market continues higher, we have 2.29% locked in. And what do we have now? Stop loss to break even, as covered in the risk management section. So let's see, will the market continue the swing move or will it react? Now, this is why you have to mark out your targets and be precise with your targets. Now, as we covered in the identifying targets section, it's important to find areas where the market may reverse. The reason being, it's good to have one big target, but the market's not always going to do that one big target. Quite often, the market will come down into a zone towards your target, tap into an area of interest that is obviously going to be somewhere the market could reverse, but many traders will ignore that because they're going for their full target and they're not considering the logic of the market. So we've taken 2.29% here, and whether or not it wins now, we don't care because we've made over 1R on the movement. If it loses, we are up 2.29%. If it wins, we're up about 7 or 8%. So we're on a win-win kind of scenario. Using this logical level, obviously a demand zone is an area that we should be focused on, even if we are in a downtrend, because we can very well get a reaction out of it, as this example very clearly and very well shows. So it looks like this trade is going to be a break even. Yep, and there we go. So we're break even on the movement. 2.29% is secured there. Nice little example. Could have been, a 5% trade if you closed it all. If you were targeting a smaller target, of course, we are trading in a swing trade, so we were looking for a larger target. But as you can see, that is how trading works, and that is how we profit over the long term. So a great example showed here. Downtrend, we use the neutral chart layout to actually get the overall market flow of the direction of the trend. We then put the colors on, focused on the Fibonacci, the moving average crossover, the bearish engulfing and structure shift on the lower time frames, supply zone, key level, and it brought us a nice profitable move down for 2.5R or 2.3R down into this demand zone. Okay, and from there the market reversed. And to be honest, I'm very glad it did because it shows the importance of managing your trades well and focusing on multiple targets. Okay, now I'm actually happier that it turned out that way than a straight win, because when you're learning to trade, you need to see the realistic setups, the realistic scenarios. You shouldn't just be seeing win, 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 win. You need to see real trading, because generally this is what real trading is going to be like, where not everything is going to work out 100% as planned. So you need to be ready to manage, execute, and lock in profits on the way through the movement in order to ensure that you don't get burned. So there we go. Euro USD, 2.29% done on that movement. And I used the moving averages, the Fibonacci's, the key levels, the supply and demand zones, the trend direction. And that generally is how you formulate a perfect setup. So as a final pointer, some trades are going to work perfectly, some trades will lose, and some will work to a degree, like this one here that you've seen, which worked out very nicely and requires management and constant focus on the logic of the market. If you see a demand zone and we see reaction in the demand zone, take some profits. If you see the demand zone crash straight through, still don't feel like you can't take some profits. It's always good to take profits, of course, in line with your risk management plan, in line with your risk reward strategy. But it's always a good idea to take some profits in logical points, because the market does reverse more than you may like to see. So hopefully you've enjoyed this video. Hopefully this has given you a little idea of how we can use those moving averages as well, and how we actually use the Fibonacci as well to identify reaction points in the market. So thank you for watching, and I'll see you over in the next video.